Friday, live from our studio in New York City. I'm Julie Hyman, that's Josh Lipton. This is Yahoo Finance Live, and here's what we're watching this afternoon. Stocks trading just slightly higher today. The major averages heading for the third straight week of gains. The November rally coming on the heels of positive inflation data, giving investors hope that the Fed is done raising rates. The 10-year Treasury yield falling in response, hitting its lowest level since September, and oil prices rising today after a sharp sell-off this week on rising supply and cooling demand.
And the UAW's historic deal with the Detroit Big Three automakers is final. Union members at Ford and Stellantis ratifying their deals today, joining workers at GM, which ratified its contract on Thursday. The deals include wage increases of 25%, cost of living adjustments, and a 3-year wage progression, among other benefits.
And finally, Apple and Lionsgate Entertainment suspending all advertising on X, formerly Twitter, effective immediately. The company's joining a growing list of businesses pulling ads in response to a post on X in which Elon Musk supported anti-Semitic views. A White House spokesperson calling Musk's comments, quote, unacceptable. Let's get you up to speed on the market action on this Friday afternoon. As we said, we're looking like we are still going to be positive on the week here. If you look at the session, we are not seeing an enormous amount of movement across the board. Slight gains for the major averages. Right now, the Dow is up by just about 13 points here. The S&P and the Nasdaq up just about 0.1% each. So not seeing a lot of sort of conviction or momentum here to end the week. If you look at the groups that are on the move, energy is up the most, and that's because we are seeing that rebound in oil prices here today after a big sell-off this week. Consumer discretionary also performing pretty well today in the wake of some more positive retail results, and communication services falling on the day about 0.75%.
Yeah, you look at the big indexes today, not a lot of drama, but of course against the backdrop that stocks have been on a tear here, so maybe kind of a breather you'd be expecting. Earnings season, of course, continues. We'll be talking a lot about those prints throughout the show. Some that have already reported, some that are on the way. Interesting stat per Bloomberg, Julie. Earnings up 4% year over year, with about 90% of the SPX, the S&P 500 reporting. So a 3-quarter streak of earnings declines could be over here. Maybe we put the trough in.
Yeah, they're done.
Although some big ones in the pipeline also, Best Buy, Nordstrom, Lowe's, and of course the big one on Tuesday, Nvidia.
Yes, we'll be watching for all of those. And speaking of Nvidia, we're watching big tech more broadly that's been having a comeback. Yeah,
so big tech's recent rally, let's talk about that, starting in late October, has added around $2 trillion in market value to the Nasdaq 100, and Wall Street betting that rally continues to the end of the year. This comes despite weak outlooks from companies like Apple and Meta in their third quarter earnings reports. You know, big picture here, Julie, obviously investors are feeling more confident. They've looked at these milder inflation reports. They've decided the Fed's moving to the sidelines, and yes, it's rare, yes, it's tricky, but maybe Jay Powell will be able to stick that soft landing that we hear so much about. And so you're looking to place bets, and one place investors have done that is in names like the Microsofts, the Apples, right? And we spoke to Dr. Ed Yardeni this week on our show, very well-known, well-respected economist and strategist. You know, he's not a trader, he's an investor. And we asked him, where do you want to put money? Not just the end of the year, but into 2024. And he piped right up with technology, another sector he's overweight.
You know, it's so interesting to me. On Tuesday, when we had that CPI report that really caused that pivot in the market and a broadening out of the rally, we had a lot of investors say, here's the broadening out that we've been looking for. Small caps are doing well. It's not just limited to tech. But guess what? If you look at the recent surge that we have seen in stocks, it has been about big tech, and not just about big tech, but about the Magnificent Seven, which accounted for about 2/3 of that $2 trillion increase. And if you look at this chart that we prepared here, so the purple line at the top is the New York FANG Plus Index, which is effectively the Magnificent Seven, although there are 10 components in that index. And you see on the right side of your screen there, the surge that those stocks had, which effectively saved the NASDAQ from entering correction. The next line there, the blue line, is the NASDAQ 100. So this shows you the extent to which the largest of large cap tech has outperformed. Next, the yellow line is the S&P 500. And finally, the equal weight S&P 500. So that shows how unbroad the rally this year has been. And on the right side of your screen there, the most recent it doesn't seem to be changing substantially, at least not yet. It is still being pulled upward by the largest of large cap tech.
And some themes here too. I mean, listen, when rates drop the way they have, big tech can work. We know
Yes.
that. There's also some themes that are just very idiosyncratic to tech. I mean, there is still this boom of interest in AI. Investors certainly believe, listen, that's going to boost the financial performance of some names, and they've tried to sort of look around what could really benefit. They've decided it's names like Microsoft and it's names like Nvidia, which reports next week.
Yeah, and of course, friend of the show, Dan Ives, is all in on
and
big cap AI and
Yep.
has been on big cap AI, out with a new note today, effectively doubling down on the thesis that he has been on for quite some time, that we are seeing this year-end rally in technology that has begun.
Ives has been consistent.
He has been.
Yeah.
All right, well, the recent stock rally, buffeted by reports inflation is cooling, driving investors to adjust their portfolios. According to data from UBS, the months of November, December, and January are some of the best for U.S. equity risk-adjusted returns. Seasonal trends suggest it could be the right time to get into certain areas of the market that have been underperforming this year. Here with more is Maxwell Grinikoff, UBS U.S. equity derivatives strategist. Max, thanks for being here. Before we dig into those specific areas, I want to get you to expand a little bit more on seasonality, which we've been talking a lot about as of late. How powerful a factor is that? And are you just, as a result, sort of absolutely convinced that we are going to continue to see a year-end rally here?
Yeah, thanks for having me, Julie. Look, market anomalies like the Santa rally, the January effect, I feel like every year they become, ever topical. So look, this latest rally has a few things going for it. Seasonality-wise, as you so rightly point to, November and December screen as some of the best months for U.S. equity risk-adjusted returns. We've already also seen a notable pickup in investor sentiment post that cooling November CPI print. That increase in investor sentiment is also seasonally in line with history, at least over the last 30 years. Now, macro-wise, that cooling CPI print also completely took December FOMC off the table as a live meeting, and rates have normalized pretty swiftly, as you mentioned. Now, positioning-wise, we've seen systematic strategies like CTAs turn net buyers, which could also further exacerbate upside flows. On the option side, we've also seen near record highs in IWM call open interest, even before the 5% one-day rebound in IWM. So investors clearly singing a different tune there.
And Max, seasonals always interest me because, Max, if we know about it and Max and Josh and Julie are all talking about it, isn't it already priced in?
Priced in to an extent. Look, I do think there are pockets of the market that have been significant underperformers. You look at small caps, which you mentioned before. I like to say in terms of small caps, every dog has its day, right? So we like upside optionality in small caps, but merely as a right tail hedge. That is for this rally in small caps to be sustainable, we think we need to see a true no recession or soft landing scenario actually come to fruition for you to see a true sort of valuation re-rating at a lot of these smaller cap stocks. And then just going back to the history point, look, history dictates that in the last 2 months of the year, you do tend to see these year-to-date laggards that have been derated all year start to outperform the leaders, whether that's due to things like tax loss harvesting or window dressing, right? And the laggards tend to be lower in terms of quality. So what we would rather look to do is look for the areas that have underperformed, but still have higher quality balance sheets, are seeing stronger earnings momentum following this last earnings season, and are more under-owned or shorted in terms of investors' positioning.
So, Max, before we get to maybe what some of those ideas are, the outperformers this year, as we were just discussing, both all year and more recently, have been large cap technology. So is what you're saying suggest that we might see a loss of momentum in that group in particular going into the end of the year?
So I think we are a bit selective. We are cognizant, we are acknowledging of the fact that growth does have this fundamental AI tailwind, and it's seeing another tailwind from the recent softening in rates. But there are other pockets of the market, more rate-sensitive pockets of the market, like real estate, for example, or staples, very rate sensitive sectors, defensive bond proxy sectors that have taken the brunt of the rates move, not necessarily having the same earnings tailwind that that large cap tech has had. So we do think there's a bit of a catch up trade in things like real estate into the end of the year, and we've already seen that play out a bit over the last few trading sessions.
What about healthcare, Max? Does that also look attractive to you, at least here in the near intermediate term?
Yeah, I would say I would lump that into the same sort of category in terms of defensive sector at the end of the day, a little less rate sensitive, right? At least top down. But when we look at that screen of, like I said, higher quality balance sheets, pick up in earnings momentum, and just more under-owned pockets in the market, that is another sector I would say that kind of fits that criteria.
Now, Max, when you're doing derivative strategy, right, this is not like a 12-month strategy. Typically, you're looking more tactically, more short-term. So if investors are looking for this kind of a strategy into year-end, how quickly do they need to pivot out of it? Or, for what kind of timeline should they set up their trades for something like this?
Yeah, it's a great question, and it is tactical, right? There is typically, at least history dictates, there is typically a 2 to 3 week window in which you see the laggards start to outperform and vice versa, and that sort of starts to reverse into year end. Now, something to note is that as you get into year end, you also start to get that Santa rally effect where everything sort of rises, so a rising tide kind of lifts all boats. But at least when we're talking about our drainers versus gainers for the year, there is a very short window, to your point.
All right, Max Grinikoff. Max, thanks so much for joining us today on this Friday. We appreciate your time.
All right, thanks for having me.
Now let's get a look at some trending tickers today. First up, let's have a look at Applied Materials. That stock is sliding on a report the company is facing a criminal investigation over violating U.S. export rules to China. So a rough day here for AMAT bulls. So the report here, U.S. criminal investigation, this is per Reuters, Julie, for allegedly violating export restrictions to China, that the DOJ is poking around, it sounds like, about its dealings with China's semiconductor manufacturing international. I guess the question is here, did AMAT sell equipment to them without the proper licenses being in place here?
Right. It looks like there was an intermediary, so there's some questions about that intermediary. The company, for its part, is saying, we disclosed this back in October 2022, that this was getting a closer look from the U.S. Attorney's Office for the District of Massachusetts. And so the company's contending this is not necessarily news to the market, but the market is taking it as news. And what's also notable here is that Applied Materials also reported its earnings after the close yesterday,
which were solid.
And the numbers were pretty good.
Above consensus,
So
yeah.
What's happening here is that this news is overwhelming the news on earnings, which is quite interesting to see as well.
Bernstein, Stacey Rasgon, friend of the show, he weighed in here as well, covers the name. So he believes it's highly unlikely, he says, the company would have deliberately tried to sidestep the sanctions. And he says these sorts of things, while they look scary, do tend to eventually get settled in a not too terrible fashion. And I thought this was, you immediately, if you're an investor, you start thinking about China exposure here, right? He does point out AMAT's overall China exposure is normalized and actually, he says, the lowest among its peers.
Yeah, so, and I saw an estimate, it's around 5%, I believe, of revenue was the Bloomberg Intelligence estimate.
Yep.
Well, speaking of scary, let's get to our next mover here. That is ChargePoint. If you're a bull, unless you, I guess, want to come in here and scoop up some shares, it's a scary day. The share's down 36%, roughly a third of its value here. ChargePoint's third quarter revenue slumping to $108 million here, and the company's replacing its CEO and CFO here. So a big
that's a lot of
miss.
changes in the C-suite.
So it says it's going to, the preliminary results, $108 to $113 million. Its guidance had been $150 million. I mean, this is a blind side of all blind sides, where you come in with a very low preliminary number for revenue. You say your longtime CEO is leaving the company. That's Pasquale Romano, who we've spoken to many times on Yahoo Finance. The CFO's leaving. And it seems like investors were caught off guard and are now trying to figure out what's going on here.
Yeah, you did, not just investors, but you were looking at least through some of the analyst notes today. They were clearly, I mean, the folks who actually cover this name on the street were clearly caught off guard as well. And the broader story, you just have these charging companies in the middle of this, also the backdrop here, who are trying to compete with Tesla, which of course has built out its own network, and car makers we know have moved to that connector. So there's also just bigger broader issues for this sector as well.
Well, on the other hand, some of the other companies that have come out with their numbers, Blink, EVgo, they actually came out and beat. So it was even more surprising, perhaps, from that perspective. JP Morgan, who has an overweight on the stock, did say the magnitude of the miss and the deceleration late in the quarter doesn't bode well for near-term fundamentals for ChargePoint or the broader EV value chain in general. So there are some questions about the read-through here.
All right, I want to keep an eye on it. Finally, let's take a look at Cava. The stock edging lower today after Raymond James initiated coverage on the stock with a market perform rating. The analyst saying investors should wait for a more attractive entry point for the stock. So this actually was an interesting note because Raymond James initiates Cava market perform, so equivalent of a hold, right? He's on the sidelines. He actually likes the name. I mean, it's a bullish note. It's a customizable menu, efficient walk line service model. Talks about an ironclad balance sheet, zero funded debt, $300 million in cash, but just doesn't like the valuation.
Right, exactly. And so, you know, it would have to come down more, presumably, in order for it to get more attractive to him. The stock has done decently since the IPO, especially if you look at it versus its peers, although that chart obviously shows it trading lower, but it is above the IPO price of $22 a share. So by that metric, has done relatively well. We were talking about it. I happen to be a Cava fan from a personal perspective. I like the bowls. I think they're good.
I haven't had the chance yet.
You don't eat lunch. So
no, I'm not a big lunch guy.
I was thinking I need to buy you lunch at Cava.
Throw a little falafel my way.
But you don't eat lunch.
Would it kill you? A little hummus?
I would love to. Give me the opportunity, have lunch one day, and I will get you a Cava bowl.
Now, if you're listening to this and you might be hearing, like, when you hear an analyst say a more attractive entry point, you're thinking, well, when is that?
Right.
He does give you a time frame here. He says maybe in the next 3 to 6 months. One reason he says potential secondary offerings. For example, a lockup, he says expiring December 11th. So maybe if you love the falafel, you love the business model, that's your entry point.
All right, we'll see if you love the falafel.
All right, let's see. All right, we are just getting started here on Yahoo Finance Live. Coming up, great expectations. Nvidia reporting third quarter results next week, and Wall Street's hopes are high. We're going to tell you what to expect there. And to buy or not to buy, that is the question, with investors largely pricing in the end of the rate hike cycle. Is it time to jump in on those declining mortgage rates? Fallout for Elon Musk as well, a growing list of companies pulling ads from X, formerly Twitter, over Musk's endorsement of anti-Semitic views. But could the backlash ripple to Tesla as well? We have more on that after the break. Elon Musk facing growing backlash over his endorsement of an anti-Semitic X post this week. Apple now reportedly the latest company to pull all advertising from X, formerly known as Twitter, following Lionsgate, IBM, and the European Commission. Question now is whether Tesla could face problems as well. And joining us now is YouTuber, financial advisor, and Tesla shareholder Kevin Paffrath. Kevin, thank you so much for joining us. I guess I just want to start there with Tesla, Kevin. You're a believer, I know, in the stock, the company, the car. I'm just curious whether you think these headlines, Elon Musk's behavior here, do you think it's going to impact the brand? Do you think it could, bottom line, hurt consumer demand for the cars?
At this point, and first of all, thanks for having me. At this point, you can't really hurt the brand any more than Elon has already done over the last year. So as a shareholder, I'm not concerned. The biggest catalyst for Tesla is very simple. Rates go down, Tesla goes up. That's very simple. I believe that is the largest position in my ETF. As far as Elon's commentary, he needs a babysitter, and he actually needs to listen to that babysitter. Unfortunately, he acts like that little brother that's a genius, but just doesn't listen to good advice. He's got to stop alienating folks. Remember, it's very simple what he did. He had three choices to that Jewish-related tweet. He had three choices. He could have said nothing. He could have gone to the light side, where he would have said, hey, thank you for sharing a positive message about reducing hate. Or he could have responded to a hateful comment that inflamed hate. Elon chose to inflame hate. That was a mistake. That was stupid. But as far as the Tesla share price, the pain's already priced in. We know Elon's a little bit of a nut. But then again, you kind of have to be a nut to create Tesla.
I mean, there's a nut, though, Kevin. I would push back a little bit on this notion that, oh, we already knew all this about him already. I mean, those of us who follow him closely, perhaps, but the sort of more explicit endorsement of an anti-Semitic view is perhaps new. You know, the advertisers pulling from X explicitly because of that tweet is new. And so I wonder, like, if it does ratchet up the negativity against him a little bit and convince people maybe if they are in the market for an EV, they're going to get a different kind.
You might absolutely be right about that. Part of me believes it's very Trumpian, where it's like same story or different story, different day, right? But it's really the same theme. It's, oh, Trump's back at it again. It's sort of like, oh, Elon's back at it again. Elon's going to walk back his commentary and say, well, I didn't really mean it that way. I meant it this way. All the Elon fans will say, hey, great, okay, no problem. And the people who probably weren't going to buy Teslas aren't going to buy them anyway. In my opinion, Teslas are the safest vehicle on the road. They're the most luxurious drive with full self-driving. They're a great tool. Now, in fairness, I'm biased. It's the largest position in my actively managed ETF. I have my own personal net worth massively exposed to it. So I do criticize Elon, though. I don't think he should be the CEO anymore. I think he should be a visionary, but he should go behind the scenes, run his companies from behind the scenes, and have a figurehead who publicly makes statements and runs advertising for Tesla. He's not the publicist for Tesla. He's the visionary, but he is hurting Tesla in the short term. Tesla would get a lot further in their green sustainability vision. Elon's dream of a sustainable future would be succeeded much faster if he got out of his own way.
And Kevin, so you'd like, and you're a shareholder, you'd like Elon Musk to step aside as running that company. Is there someone you'd rather have step in?
We need somebody like Tim Cook. I like to call him Tim Cool, mostly because he's relaxed. He doesn't rock the boat. He provides the product launches. He provides inspiration, provides a vision, but he's not upsetting people. He's not creating negative drama around a brand. Negative drama is what influencers are good at, okay? I consider myself an influencer. That's like a YouTuber thing. It's a politician thing, like a Donald Trumpian thing, but not the CEO of a company that's trying to appeal to moms and dads and to ordinary people who want to keep their children safe, their parents safe, their family, their friends safe in a car. This should appeal to everyone. This should not be a political decision to choose or not to choose a Tesla.
Kevin, it doesn't sound like you're dissuaded at all. Like, are you, we heard we saw Ross Gerber tweeting he's going to get rid of his Model Y next year and get a Rivian instead. Are you unloading any shares? Are you getting rid of your Teslas?
No, not at all. And that's Ross's wife's car, who is afraid of using full self-driving. And it just reiterates the fact that Elon Musk needs to advertise to the community and teach people how great full self-driving is, how much safer full self-driving is. So, Ross, he'll never give up his Tesla. I guarantee it, because he loves that full self-driving too much. And I love Ross. I think Ross is a great person. His fund is amazing. GK, I love him. He's a great person, but he's not giving up his Tesla. I'm not giving up my Tesla. I'm not leaving. I'm staying here.
I would debate full self-driving with you, but we'll save that for another day, Kevin. I got one more question for you. Where the heck are you, and what is this hat you're wearing? Explain to me what is going on right now.
Oh, yeah, well, I shaved my hair because I lost a bet. I'm going to look at real estate, so I flew out here, and now I got to go work for my other business. It's called House Hack. We're a real estate startup. Thanks for asking, All
right, Kevin Paffrath, good to see you as always. It's never boring. Thanks, Kevin. Appreciate it.
Thank you. Bye.
Well, in other car news, Cadillac confirms the fourth vehicle to join its expanding global electric vehicle portfolio. Here with the details is our in-house car guy, Yahoo Finance's Prosper Manian. I don't even know how to follow that, but let's talk about Cadillac and this offering here.
Yeah, the entry-level Optic, as it's known, the entry-level Cadillac is here. Sort of like, I believe, the size of the Chevrolet Equinox EV, which is their entry-level, small-size, Ultium-based EV. I reached out to Cadillac about they wouldn't confirm or deny whether it was the Equinox size, but I believe it is. So that Equinox EV was going to cost around $40,000-ish. So I'm assuming this Optic, the entry-level Cadillac, will cost maybe around $50,000. They already have the Lyriq out right now, which is a bit larger, and that costs around $60,000. So I think that's where that Optic will slot in, and it is the same size as the Model Y, and it'll probably compete in that space, in that small crossover EV area. So one thing I want to note, though, is that in China, there's a similar model that came out. It's powered by cheaper LFP batteries and two motors, or one, depending on how you want the configuration. I'm not sure if that'll happen here in the States, but it gives you an idea of how they might cut costs there for that car.
It's interesting, just a broader question, Praz, I'd love to get your take on. These kind of broader questions about the EV market, kind of where it is and where it's headed. Like, there's a good piece in the Journal today talking about, sales plateauing, inventories piling up, folks are slashing their prices like Tesla. When you talk to analysts, where do they see the market headed from here?
I think big picture overall, we are going to go EVs at some point. It's going to happen. Just may not happen as soon as people thought. 2030 was that year that we were thinking of. At least the Biden administration wants half the cars to be EVs. That may happen, but it's still a ways away, and there's a lot of challenges with pricing and infrastructure. I think pricing right now is the biggest issue. A lot of people can charge at home, so it's not that big of a deal to not have a charger away from, for us, it's different living in the city. But I think that's the big issue, is can you get cheaper cars here? And the Cadillac Optic is going to be one of those.
And how have the other Cadillac EV models sold, first of all? And secondly, we talk so much about Tesla and Ford and GM, but like Hyundai has a bunch of EV and plug-in hybrids. VW's got, those seem to be gaining some traction as well. So what does the fuller landscape look like?
GM has been sort of late to the game because they wanted to develop that Ultium platform, and they haven't had that many Lyriq sales. I think only a few thousand as of to date, and that's the only EV they have. The other EV they have is through Cadillac. Right. And GM has sort of delayed a bit of their Silverado EV sales. Right now, they're only selling the work truck, which is like a pro model. But you're absolutely right. Volkswagen, they've been going pretty hard with their ID4 and cars like that. Hyundai and its sister brand Kia, really killing it from like a volume point of view, car point of view, well-reviewed cars. They just put out a new Ioniq 5N, which is like a sporty electric EV at the LA Auto Show. Looks great. People love that car. It can also do bi-directional charges. You can charge like stuff in your house. These guys are really doing it in terms of.
To me, that's like the stealth
volume.
thing that is not getting as much attention, because we talk about Tesla all the time.
Right, and I know you guys talk about that Amazon thing that they did with the partnering with them to sell cars. So that they're definitely moving the needle there with the mass appeal, mass sort of selling of cars, EVs in this country.
All right, Praz, thank you for joining us, sir. Have a great weekend.
I forgot my hat, though. I didn't have my hat, though. So.
Next time, with the feather, that's what's key.
Yes.
Yeah, you got to have that, or it doesn't work. Those are the rules. All right, coming up, tech on deck. Nvidia reporting third quarter results next week, and Wall Street's hopes are high. We're going to tell you what to expect. It's been a pretty bullish week on Wall Street, and Jared Blickery is here with all the details. Jared.
Well, we're going to get into some heat maps in a second. First, wanted to point out that we actually saw outflows in the bond world for the first time since 2023. But as far as stocks are concerned, this was the second biggest week of flows for the year. And then if we drill it down into large caps, and we know the mega caps are a subset of that, they are seeing their biggest inflows since February of last year. And just want to finally point out that we did have a number of big releases this week. We got a huge reaction off of CPI recently, but I want to go back and judge the week's price action through some of our heat maps here. And this is a 5-day look at the sectors. These are large cap sectors. Real estate, number one, they're up 4.5%, followed by materials, consumer discretionary, utilities, financials, and industrials. I want to quickly point out that we're in the midst of a 15-day rally where tech is up 13%. That has really been stealing the show, but taking a backseat to real estate this week. Now, let me move on to the Nasdaq 100 here, and you can see a lot of outsized moves. Tesla stands out, that's up 9%, a couple issues up 10%. Microsoft looks like it's going to close in the red there. And then taking a quick look at the Dow, Cisco is one of the worst off here, the worst off, down 9%, Walmart down 6%. These are earnings stories, but for the most part, you're hard pressed to find any board that is mostly red. Now, here's my leaders, and only crypto is in the red right here. But number one is TAN, that's solar. That's a solar ETF, followed by ARK, that is disruption. And then regional banks, they have bounced back really nicely this week, and meme stocks. And let's just head over to meme stock land where we can see a sea of green here. Robinhood in the red, but for the most part, seeing a lot of green. Carvana up 9%, DDS up 15, Coinbase up 5.7. I did say that we're not going to see too much red here. Let me go to a 7-day look so I can show you crypto. This is one of the red spots taking a back seat. Now, Bitcoin had broken to the upside earlier than this week, and it's still maintaining to some nice gains there. Here's a 15-day look, still up 5.5% there. But let's move on. We have retail. That has been something that we have been taking a lot of looks at this week, and that has to do with all the earnings that have come out here. And we're going to go back to a 5-day look, and there you go. You can't see it from here until I sort by equal weight, but we have some really outstanding smaller cap stocks, or at least they're smaller caps, really outperforming. Gap up 31%, so is Macy's over 30%. Target up 20, Kohl's 17. Only a few of the bigger ones are trading to the downside here. That includes TJX, and we already talked about Walmart there. And let me show you what's going on in apparel, a subset of retail. You can see incredible green on the screen here. Some of these names are, there is a little bit of cross here. Gap, that's in the same one, that's up 31%. But look, Crocs up 14.5, Buckle up 14 as well. And let me just close with this. I did want to take a look at the travel sector, and I can dial that up right here. And there you go. Lots of outsized gains here. Royal Caribbean up 10.8%. United Airlines up about 4.5%. Guys.
Thanks so much, Jared. Appreciate it. Well, the last of the Magnificent Seven set to report third quarter earnings next week. We're talking, of course, about Nvidia. Here with a look at what to expect is Citadel Professor of Accounting and Finance Paul Meeks, and of course, veteran tech investor as well, who we've talked to frequently on this subject. Paul, when you look at Nvidia and how it's setting up here, the stock is up, about 240% year to date. Everybody views it as sort of the uncontested leader in AI here. What are we looking for specifically from the company in this report?
So I don't think there's any question that they'll upside the consensus estimates. And if you're keeping score at home, that's $3.10 in non-GAAP EPS and $14.9 billion in sales. But I am worried about this. I am worried that we have a repeat this quarter of what we had last quarter, where they also crushed the numbers and gave pretty good guidance. After the call, folks raised their numbers all over the street, yet the stock took quite a hit. And so I think the expectations are so high for NVIDIA, and we do have some potentially scary things, not in the near term, not in the intermediate term, but in the long term, with slowdown of purchases to China. Can we ever resolve that export mess? And also, what happens when the cloud hyperscalers get their fill of these NVIDIA GPUs for AI and actually go into a pause mode where they digest their purchases? Because right now they are buying everyone they can get. And these are very high average selling prices and incredibly high margins for Nvidia. So I just worry about the reaction, not the fundamentals that we'll see reported next Tuesday afternoon.
And Paul, you did touch, though, on one subject, which is going to for sure come up on the call, and investors in the street, they're going to want more clarity on, which is China. You know, it's an important market for Nvidia, but at the same time, Paul, we see these tightening of U.S. restrictions on chip exports. How big an opportunity is China for Jensen Huang and his team over at Nvidia long term there?
So long term, it should be at least 25% of the sales in the data center. So it's significant. And if this goes to zero or somewhere close to zero, that is going to be meaningful. And that'll really cause a downgrade in the longer term estimates. Now, this year, the company is going to do about $10 in non-GAAP EPS. It's about a triple from last year. Next year, the forecast is for 15 or 16 bucks. I think that all is well there. I expect them to continue to upside next year. But yes, over the long term, you hit the nail absolutely on the head. What happens to China? Can they continue to tweak their projects and sneak them past the goalie, which is the folks that are looking at holding back those purchases for defense use in Chinese products? But we'll see. Right now, it's not good for the long term. In the meantime, I think we're okay for the short to intermediate term.
Paul, we have had some other companies making some announcements recently that they're getting further into AI chips. Qualcomm, among them, Microsoft, with some in-house chips and programs that it is now introducing. Does any of that threaten the leadership that NVIDIA has? If not now, then down the road? Or is this market big enough that you're just going to have all of these players?
I think there'll be more players. I think it's very difficult to manufacture these chips. And so NVIDIA will always have, I don't want to say the lion's share, but they'll be the number one player in the market, probably by a margin. But I don't think any of these announcements that you've seen are going to impact them negatively and have them lose much share in the next fiscal year, and probably even beyond a bit.
And another question, Paul, that I think investors are going to have is, listen, NVIDIA is the face of this boom of interest in AI. But one question I think folks are going to have is the supply of GPUs and whether NVIDIA can get its hands on enough. Is that one question you'd have going into the print?
Oh, yeah. No. Now, the supply logjam is going to be a little bit alleviated this time round, which is, I guess, a good thing. But then even if they continue to have problems shipping, which they will, you're thinking about building an enormous backlog. And unless you think that those bookings will ultimately be debooked, it'll really add a lot of visibility to the forecast for both revenue, earnings per share, and even cash flow.
And Paul, just quickly, more broadly here, we've been talking really throughout the show thus far about this surge recently we've seen in tech, that despite all of the hand-wringing that people have done all year about, we're too reliant on the tech rally, it's still happening and stocks are still rallying. Do you think anything changes on that front into year end?
I don't think so. And the reason that the tech stocks have come back, because remember, they went straight up from January 1 to the third week of July. Then they went straight down, actually a fairly significant correction, only to rebound. And the reason they started to rebound a few weeks ago was nothing to do with AI or all these other drivers that we talk about fundamentally. It's all about rates, right? Back then, the worry was rates going up even higher than expected and then staying higher longer. And now with, as you mentioned in the prior part of the segment, now with the most recent inflation news, maybe we're seeing some glimmers that at least some point, probably not early in 2024, but later on, we'll actually see the first cut in rates. And these stocks will be turbocharged based on that. And that is the 80-20 rule. Rates going down, tech stocks going up is 80%. The fundamental stuff that's actually probably more cool to talk about, only 20% of the driver of these stocks.
Wow, that is a good reminder. Well, we always like talking to you about both of these things, the fundamentals and the other stuff like rates. Paul Meeks, great to catch up with you.
See you later. Thank you.
Coming up, our next installment of Yahoo Finance's week-long healthcare special. We're looking into regulation in the space. That's after the break.
Welcome back to Yahoo Finance Live. I'm senior health reporter Anjali Kimlani. As part of Yahoo Finance's week-long healthcare special, we're looking into regulation in healthcare. The Food and Drug Administration finding itself in a number of new and ongoing efforts to regulate and improve medicine in the U.S., whether it's addressing AI or working on more robust evidence generation after approval of a drug. Joining me here now to peel back the layers in the future of medicine is FDA Commissioner Dr. Robert Califf. Commissioner, so good for you to join us today. This is something that I know you've been talking about for a while, and certainly all year. Looking at that robust evidence generation needed, there are definitely new areas of medicine that we are seeing come out. For example, the weight loss drugs that people are so focused on, Alzheimer's disease drugs, as well as new innovation areas like CRISPR that we've just seen approval for over the pond. So I just wonder, with all of this going on, how do you think about the need to look back after approvals and what is needed to make sure that these medicines are safer for us?
Yeah, thanks. That's a great question. It's good to be with you. I prefer to call it looking forward rather than looking back, because the way our system works, we have very robust clinical trials that are done to get a drug on the market. And by the way, I'd put high-risk devices in the same category, where you got to show that your product produces a health benefit that exceeds the risk for a particular population under particular circumstances. But after that product gets on the market, there is no evidence generation system like what we have in the pre-market phase. And yet we have all these questions that are still on the table that need to be answered. The weight loss drugs may be the easiest to talk about right now, because everyone, I think, recognizes there's so many questions. Who really should be treated? Are there subpopulations where the benefits outweigh the risks? What are the right doses, really, out of all the possible doses? You have to prove you at least have a dose to get on the market, but you don't have to prove you have the best dose at that point. So many questions left to be answered. This is not directly in the FDA's regulatory control. And so what we're doing is more saying we need a system to do this. FDA plays a role, but so do many other parts of the government and the private sector.
So who do you need to help make this happen? And what do you anticipate the pushback could be from companies? Because this is adding just another layer of administration for them, whether it's sponsoring the trials or sponsoring studies and really investing in that follow-up.
Well, we got to parse that out a little bit. So first of all, your presumption is that companies are going to pay for these post-market studies, and companies certainly do, but we all know that the metric for a company doing a post-market study is a net present value calculation. It's not a public health question. And so there's a big issue as to whether public funding should be used for some of these studies, because the answers are so critical to federal agencies like CMS, who after all have to pay a big part of the revenue that these companies make. I'd also say there's some circumstances where FDA does have jurisdiction because there's a safety issue. And if we look at the what's going to be a real amazing increase in gene editing therapies that are about to hit the markets, we're going to need long-term follow-up in those patients, because no one knows what the potential impact of things like off-target effects might be. So that's a case where the industry does need to pay for it in return for getting the product on the market. But for a lot of this, it's more of we all have a stake in this, and we need to figure out how to put together a system that generates the best evidence. And don't forget that if you prove that your product is better than the competitors, that's a pretty good market.
It certainly is. I also wonder about another area that you've talked about, and this kind of plays on the idea that, the FDA has so much more that it has to look at with all the innovation coming out. AI, for example, I know you've talked about the harms that it has caused in the past, but you've also been looking at approvals for uses, especially in the med tech space. What are you thinking about how the FDA needs to think about what is coming down the pike? You have a background at Alphabet, so you've definitely seen what's been going on behind the scenes.
Well, it's really exciting. But like most major breakthroughs that are exciting in medicine or society, there's also a downside. So we have to keep both in mind. Also remember that we've already put through the system hundreds of devices with AI algorithms built into them. So we have experience. And actually, when AI is used for prediction, which is the biggest use right now, we have a regulatory scheme, which I think is pretty good. The system needs to get better because one of the really key things about AI algorithms is if you put them out in a clinical system and don't keep tuning them up, they don't work as well over time and may actually trend in a very negative direction in terms of their capability of predicting. So we need a system where, again, that post-market phase becomes absolutely critical in getting it right. But the thing I think we're all struggling with is generative AI, which is a new thing and something we don't really know how to regulate at this point, but we have some pretty good ideas. It does fall back on some of what I said already. Someone's got to keep an eye on it. But this is so explosive and potentially helpful, but also potentially detrimental. This is really going to take an ecosystem approach. We're going to need the academic medical centers and other entities to work together to have a system of governance that's put into place. There'll be a lot more to come on this. We're working on it right now, but we're going to need to work this out.
Definitely. Generative AI is certainly on everyone's mind, and we'll wait to see what you have for that. Meanwhile, I want to give you a chance to talk about Dr. Janet Woodcock. I know she's retiring at the end of the year. Principal Deputy Commissioner, really an important role, pivotal role during the pandemic, but also leaving you with, as well as leaving a wealth of institutional knowledge. What is the FDA going to have to do to fill that role?
Well, as you might imagine, if you know Janet, you know this wasn't a surprise. We've known about this for a while. So we've been working on it, and we've got a good plan to fill those roles. I think what Janet has not gotten enough credit for, which you're alluding to, is that she actually has done more things than you could ever even imagine within the FDA with a tremendously positive impact. If you just look at what she's done in leading the reorganization of the food side and the inspectorate at the FDA over the last year, it's really remarkable. But trust me, we've got a plan. Janet, of course, has been involved in the plan. She wouldn't leave without leaving things in good hands. But make no mistake about it, we're going to miss Janet. She's really put in 4 decades of work at the FDA, and she's so trusted both inside and outside the FDA for sound decision-making and thoughtful regulation.
Absolutely, and they're with you through your 2 terms in the FDA. Well, we'll have to leave it there. Thank you so much for joining us today, Dr. Robert Califf, FDA Commissioner.
It's good. Please take care.
Coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
Breaking news, Sam Altman is out as CEO of OpenAI. The company just announcing a leadership transition, and it appears Altman was fired. The board saying Altman had not been consistently candid with the board. He will be replaced by Mira Murati, who currently serves as CTO, Chief Technology Officer. So this is an earthquake, really, Julie. Sam Altman is a big name in Silicon Valley. What we know right now is the board has said Sam Altman's going to step down as CEO. The CTO steps in here as sort of interim while they look for a permanent replacement. I think the money quote here is the board saying that it conducted a deliberative review process, concluded he was not consistently candid in his communications with the board, hindering its ability to exercise its responsibility. They go on to say the board no longer has confidence in his ability to continue leading OpenAI.
Yes, exactly. So this raises a lot of questions. What exactly happened here? And perhaps more information will come out at this point. Why is this so important? Why is this so earth-shattering? He's not just a big deal in Silicon Valley. He has become the face of AI, or at least one of the main faces of AI. He's testified before Congress. He's met with CEOs. OpenAI, of course, a main partner for the likes of Microsoft. And, ChatGPT has really been the AI product in generative AI that has changed the perception of its abilities earlier this year, and he is intertwined with all of that. So the fact that he is now effectively being fired, and he also co-founded OpenAI, by the way, all of this is a very big deal. As part of it, Greg Brockman, who co-founded it, this organization with him, will be stepping down as chairman of the board as well. He'll remain in his role at the company, though, reporting to the CEO, who, again, on an interim basis, will be Mira Murati. And then presumably they'll either appoint her permanently or find another permanent CEO.
Yeah, I mean, you look at OpenAI, listen, it went from kind of small nonprofit to a multi-billion-dollar company. And it was Sam Altman who helped steer that, right? Mm-hmm. They unveiled their AI chatbot, ChatGPT goes viral. It was Sam Altman who helped convince, the likes of Microsoft, which has put in more than $10 billion into this company. And as you said, also, Julian, it's a good point. It's not just OpenAI. He is truly one of the preeminent faces of the industry. It's Sam Altman who was on Capitol Hill talking to lawmakers about what future regulation could look like. It was Sam Altman who, just this week, talking to APEC about what the future of AI is going to look like. So this is a big deal. As you said, a lot of questions, though, about what exactly happened here.
Yes. Will we hear from Sam Altman directly? Will we get more information about why he was asked to leave? What will he do next, if anything? Will we not hear from him for a while? Will he move to another organization? A lot of questions that I think we'll be looking at for quite some time here. But in the meantime, we have to turn to something that we do know more about a little more conclusively today, and that's what's going on in the markets as we close things out. The Dow, little change to the downside here, off by 5.5 points as we approach the closing bell. The S&P 500 up just 0.1%. The Nasdaq, little changed as well. If you look at the week for the major averages, it has been a positive one for all three of them. The Nasdaq up about 2.4% on the week. The Dow up a little less than 2% on the week, and the S&P 500 up 2.2% over the course of the week, with, of course, Tuesday, as you can clearly see on that chart, being the big pivot point when we got that CPI number. And there is the closing bell on Wall Street. As we close things out, we were just talking about the week that was for the major averages, all of them gaining in the neighborhood of 2% or so or more on the week, on the day. The Dow just squeaking out a gain there. It looks like just a few seconds ago we were looking, it was down 5.5 points. Looks like finishing up a little more than 2 points here. And I'm just taking a quick look at the Wi-Fi Interactive at the week here. It is pretty remarkable, the pivot that we had for the S&P 500 and the other major averages, and the Russell 2000 for that matter. Let's do a quick check on the Russell on the week, up more than 5% on the week. And there's been a lot of talk amongst the strategists that we have spoken to about end-of-year seasonality, that we are entering a strong period. We talked to Max Grinikoff at the top of the show from UBS, who pointed that out. He said in the short term, This implies that small caps in particular could do well. But he says if we start to see more signs of a recession, then that movement could be short-lived. Looking at some of the sectors on the move here on the day, tech down the most, energy up the most, as we saw a bounce back here in oil prices. And then just quickly on the week, real estate, the big winner here, up 4.5%. And then consumer staples, the laggard on the week, Josh.
All right, let's get some tickers as well. Look at some of the top trending ones we saw in today's trade. Shares of Gap, let's start there, surge on better than expected results, proving its cost managing efforts are paying off. Retailers seeing improving profit margins as positive signs at Old Navy and Gap bounce the continuing work underway at Athleta and Banana Republic. So this one is interesting. Big pop today. I mean, better than expected Q3 results. So same stores fell, but less than expected. So that helped. Old Navy picking up maybe some of the slack. Julie from Banana Republic and Athleta. Old Navy comparable sales rose for the first time since 2021. Gross margins, they improved from a year ago above consensus. So, and that was kind of one theme we did see this week from other retailers too. You just saw them kind of pulling levers to improve profitability, even as same-store sales declined.
Yeah, so one of the things that really stuck out to me were some comments from Ike Burchow over at Wells Fargo, who said Gap delivered the most compelling beat this EPS season, even with a very high bar to clear. So I thought that was quite interesting. It bodes well, perhaps, for Richard Dixon and his turnaround efforts at the company. And also, I kind of was trying to situate it in my mind in the bigger retail story that we have heard from, you know, that some of these beaten down retailers that really have struggled, some of them are starting to gain a little bit of traction, you know, on the margin side as well. That's something that we've been watching closely. Inventory levels broadly are much healthier now. Gap was one of those that we heard that from as well. And then it also perhaps has some implications for some of the retailers that are still yet to trickle out, right? We're getting towards the end here, but we still are going to hear from Abercrombie & Fitch next week, as well as American Eagle. You could argue that there's some crossover between those and the likes of a Gap or an Old Navy. So we're watching those stocks as well in today's session.
More to watch next week for sure.
Yeah, definitely. And sticking with retail, I want to talk about BJ's Wholesale, because as we talk about the sort of themes in this retail season, on the one hand, you have the beaten up ones like Gap. On the other, you have this theme now, as highlighted by Walmart, of deflation. In other words, yes, inflation made it much tougher for a BJ's customer or a Walmart customer overall, but it also allowed, to some extent, these retailers to raise prices. So now if there is deflation on the advantageous side of that equation, as Walmart pointed out, that means their customers are going to be in better shape, but maybe the margins are going to come under some pressure. So that's something I think we're going to continue to watch closely. And BJ's having lower comparable sales growth. Yeah, BJ's in the red year to date. I'm just looking through some of the analyst commentary as well. You know, Baird, for example, now they're still believers, outperform, so the equivalent of a buy there. Their price target, they told their clients, is 80. They like what they saw in membership. They like the profit results, but the market, they note, is going to focus on those softer sales view, at least near term here. And you can see those sliding today. Yeah. All right, final one here. Let's look at Ross Stores reporting a beat on the top and bottom line while raising its full year 2023 earnings outlook. Several analysts also raising their price targets on Ross Stores following those upbeat results we saw today. So this was another discount retailer, clearly. Q3 EPS of $1.33, that was a beat. Sales $4.92 billion, that was a beat as well. Comparable sales up 5%. Analysts were expecting something like 3%. I thought the interesting commentary, though, from the execs, and they highlighted, listen, there's some near-term reasons for caution here. They pulled out macroeconomic volatility, persistent inflation. They even talked about kind of the new geopolitical uncertainty we're seeing, which they said, listen, if you want to know why we're maintaining a kind of more cautious, prudent outlook, that's why. At the same time, if you take Ross in combination with, say, a TJX, right, again, pointing to that consumers are still spending on apparel, right, and home goods in the case of TJX. They want to save some money, though. They want to feel like they're getting a deal. So I thought it was pretty notable here that the company saw that 5% comp sales gain that was 2 percentage points better than estimated, right? So that there's just a lot of unevenness during this retail holiday season, earnings season, we're going into holiday season, in terms of the trends that we're seeing. But the choicefulness, right, the desire to save money, those things seem to be one of the through lines that we are watching.
And it's interesting you bring up TJX too, because they were similar in that strong prints, but maybe conservative profit forecasts, at least relative to expectations.
Yeah, good point.
All right, all three major averages clocking in 3 straight winning weeks. This comes after a week of solid gains as investors make their bets on the Fed's next rate decisions. Here with how investors should be eyeing future asset allocation, we turn to GenTrust principal Matt Kishlansky. So Matt, thank you for joining us today. Let's just start with this market, Matt. I mean, stocks have been on a tear this month. I'm interested to get your perspective on whether you think the rally continues here, Matt.
Yeah, thanks for having me back. I don't think there's any way to ignore the pretty wild emotional swings that the equity market has gone through over the last 6 months. From the summer going into the fall, you started with the market you could almost hear the equity market chanting, AAI, AAI. And that suddenly turned into IXIC as we got into the end of the summer and the beginning of the fall. And then over the last few weeks, it's kind of upgraded back towards, hey. And I think as you look at that mood swing that the equity markets and their investors have been going through, I think it's easier to see it if you zoom out and appreciate that investors are coping with the realization that we're going to have rates higher for longer by kind of experiencing the 5 classic stages of grief. We started in this summer with stage 1, denial, despite all the evidence that we would have higher discount rates, despite a pretty tepid Q1, Q2 earnings season that was all about cost management and not about growth. Investors put the S&P price to earnings multiple from 15 all the way up to 20, until abruptly we entered stage 2, which is anger. And we saw a lot of reversal in those gains, particularly among the so-called Magnificent 7 mega cap stocks that had fueled so much of the warm weather rally. I'd argue that starting about 3 weeks ago, we entered into phase 3, which is bargaining. In essence, the market came out and said, okay, fine. I don't need to keep all the froth that I built into some names like Tesla, maybe Google, but I definitely need to keep the froth in some of my other names, Nvidia, Microsoft, Apple. And so what you've seen over the last 3 weeks has been a close to 10% rally in the S&P, and that's pushed forward earnings, 1-year forward earnings in the S&P. I think at one point this week we touched 19. And again, that's all on the back of the Q3 earnings season, which was modest and much like the front half of the year was all about cost management and not about revenue growth and growth in general. And so I think investors, to answer your question, they really have to ask themselves, how much longer can companies continue to either pass on costs to consumers or reduce spending on things like payroll, inventory, R&D? And I think that question gets into starker relief when you look forward at a 19 times forward multiple and infer from that earnings yields will be at or below what investors can get in overnight cash yields or in easily obtainable fixed income yields. So the question here is are we about to enter into stage 4 of the classic stages of grieving, which is depression? And does that mean when we stay here, we stagnate at this price range for the foreseeable future until companies can reliably prove that they can beat these modest growth targets that they've set for themselves? Or do we see PE ratios come back down to a low enough level that investors can reach stage 5 of the grieving cycle, which is acceptance?
Matt, you're the pro here. What do you think?
I think people are really trying to get a handle on the volatility on both sides of the inflation and rate coin. And I think that's really where we see a divergence of opinion. I think some people, again, see that 19 or 20 multiple and think we need to come back down, particularly given the headwinds we're potentially facing in 2024 with either somewhere between a soft landing and a recession. I think that's where GenTrust comes out. We are a little bit underweight equities. There are pockets within equities that we like, but we'd rather be underweight with our allocation being towards things that are long rate stabilization. But we, as long-term investors, still view these multiples as a bit rich.
And Matt, when you say there are pockets in the equity market you like, what are some of those pockets, Matt? What are some sectors you would still find attractive at these levels?
Yeah, absolutely. We continue to think that there is a slow but very persistent trickle of federal funding coming towards infrastructure. And so there are a number of names that we like and within the infrastructure sector that we think it's a slow grind, but the money is being dispersed. It's been funded by Congress and will continue to flow through. There are other areas that we like within energy, both traditional old school energy as well as some of the newer cleaner energy areas. And I think what's important for investors to realize is you can have it both ways in energy. I think you can see short and medium term profits from traditional sources, but also appreciate that on the long term, there is a transition coming to clean energy, and there's profits to be had in both camps.
And Matt, what about on the fixed income side? How do you think folks should be positioned right now?
Well, I think that's a tricky question. I think, again, there's two camps. Some people want to have a heavy overweight to cash. Their view is they still see a cloudy inflation picture, volatile inflation prints, and they're concerned that long-term rates can continue to go up materially above 5%. I think at GenTrust, we are more interested in picking up duration here. We recently took all our profits on tips trades that we had that went, as inflation picture has gotten a little bit clearer, we took a significant amount of profit there to grab longer-term duration. We view the insurance value in fixed income now to be stronger than it's been in quite some time. And we're happy to grab and hold yield. I think some investors, the challenge they're facing is they have a lot of the same way risk. If you're sitting on a lot of equities and a lot of cash, if you hit a deflationary bump in the road, which to a large extent is by definition something that nobody expects, you're going to see overnight yields plummet and you're going to see your equity portfolio plummet at the same time. So for the first time, grabbing duration can give you some insurance there. And it's certainly attractive to longer term investors.
All right, Matt Kishlansky, thanks so much. Appreciate it. Have a great weekend.
Absolutely. Thank you.
Recent data showing inflation cooling has sparked hope for investors as the Fed is finished with its rate hike cycle. As a result, mortgage rates, of course, have fallen 3 weeks in a row, but they are still elevated. The 30-year fix sits just below 7.5%. So is it really time to buy a home, or should you keep renting? Danny Romero is here to help us answer that question. Maybe you should speak directly to Josh.
No, I'm off. I'm forget it.
No. Okay, sorry. Well, there are a lot of people asking this question right now.
Well, hint, hint, it's still cheaper to rent. Asking rents is above $2,000. That's what Zillow reported. But if we compare that to the median monthly payment, that came in at $2,670 in the last 4 weeks in November with a 7.5 mortgage rate. But we have to consider when buying a home, you need a down payment. And Realtor.com says that the median down payment was about $30,000 and the average down payment was 14.7% of the sales price in the third quarter. That is a high. So that means a lot of people are forking up money for their down payment. The other thing to highlight is that both markets are noticeably expensive, the rental market and also the market to buy a home. Rates also play a really big role. And like you mentioned, the 30-year fixed mortgage rate did come down from its highs in October, but it's still well over 7%. Buying a home is still very expensive. The median sales price is above is well above $369,000. That is about a 3% on an annual basis high. So it's still pretty expensive. And sellers are actually getting more, they're giving off incentives to kind of push sales through. So we could see a little bit more of that, but I don't know how much of this relief on the rates will really push buyers back into the market.
Did you get any sense of where you thought rents might head from here? I mean, as elevated they are, where the trajectory is headed?
Well, rents are pretty flat right now on an annual basis, and there's been so much supply that has been added to the market that a lot of analysts on the street are expecting the market to really digest that before developers start building even more. If anything, there's a lot more focus on the single family homes than there is in the multifamily homes. And so I think that's really kind of where the direction of where possibly the housing market may be, right? But even though they're ramping up production on the single family, it's not that high. It's in the single digits. That really does show that there is some caution on the builder side.
All right, Danny Romero, thank you for that. Appreciate it. And coming up, the commercial real estate industry facing headwinds because of COVID, but one bright spot, hotels and hospitality. We're going to tell you about the investment opportunity in that space right after the break. The evidentiary phase of Google's antitrust trial over its search engine has now wrapped up, and that evidence, including a blunder by Google's own expert witness, revealing more about Apple's relationship with the tech giant and the cash it makes from default browsing. The judge's decision is not expected until May, but Alexis Keenan has been looking into how a win or loss for Google could impact Apple. Alexis.
Yeah, so at the heart of this case, the Justice Department is saying that Google is abusing its monopoly in online search, right? That its search engine as a default is contracted with Apple and other mobile device manufacturers, computer manufacturers to be the default search engine. And Apple, though, is kind of a de facto defendant here because Apple faces significant risk. Apple is the beneficiary of most of these payments that flow from Google to the manufacturers. And so a win for the DOJ here would really possibly invalidate these contracts. And if they went away, it would cost a lot for Apple. So let's take a look at what those numbers actually are. And this is what came out as evidence in the trial. It really illustrates how lucrative they are. In 2021, Google paid a total of $26 billion across the board for this search default placement. But when it comes to Apple, that number isn't specifically known. It's still a mystery. But what we do know is that they take the lion's share of this money. And also we know that the New York Times, as well as analysts at Bernstein, have put the figure at somewhere between $18 billion and $20 billion per year. So a huge chunk there. And if that is true, if that $20 billion, let's say, is true, that represents somewhere over the last 3 years, 5.5% to 7% of Apple's annual revenue. So a sizable chunk. Now, these analysts that I've been talking to about this issue, they also say that, look, no matter what, this is a huge number. If it's compromised, it would be expected to implicate Apple's stock price as well, that investors put a lot of value in this number that comes in under Apple's services sector. But it is certainly something to watch. And as the case goes forward, it's not going to be quite some time until we know what the outcome is. The judge has set closing arguments all the way until May of 2024, so we're not going to learn anything until then.
Yeah, I was going to ask what the next step was. I mean, it's so interesting because Apple just doesn't tell. I mean, we know to some extent what makes up the services revenue, right?
Right. It's opaque, though.
Because, you know, people who are in the Apple ecosystem, they know what they're paying for. I guess there's no chance that Apple itself is going to come out and say, this is what these are the various. Josh is laughing as somebody who has covered the company closely.
Yeah, I am interested. I mean, has Apple talked about this, Alexis? Have you gotten any response from Cook's company there?
We tried. I haven't heard anything back yet. I think this past year it was about $85 billion in that bucket. And our trusty reporter Dan Howley, our tech reporter, he and I have many times slacked back and forth and tried to figure out how to apportion each of these, within that services bucket. But look, Apple has acknowledged in SEC filings, they do say that this regulatory scrutiny, this legal scrutiny, that this could be a problem for its relationships with what they call tech company relationships. They don't come out and say, well, it's Google where the money is flowing from, but they do at least say that this is something that could put them in some jeopardy.
Really interesting. Following the breadcrumbs.
Yeah.
Alexis Keenan and Dan Howley for that matter as well. Thank you so much. Appreciate it. Well, the commercial real estate industry facing headwinds because of COVID. One bright spot has been hotels and hospitality. JLL out with a new investor survey. Even though deal activity has been slow this year, it is showing that more than 80% of investors expect to be net buyers this year within that sector. Joining us now, JLL Hotels and Hospitality America's CEO, Kevin Davis. Thanks for coming in studio, first
I appreciate
of all.
it. I'm glad to be here.
It's new digs here for us, and you're one of the first people who's come in. So what really stood out to you from that survey? Because, as I said, it has been a tough year for investment in hotels. Is it rates that are changing the equation?
Yeah, so I think investors are increasingly optimistic from a rate perspective. We just had a benign CPI report, PPI report earlier this week, suggesting that inflation may in fact be under control. So I think there's the view on the part of many investors that the worst of the rate hikes is over, and in fact, we could see some rate cuts next year, which means that investors are a bit more optimistic. The cost of capital, the cost of debt will be lower. So I think that could ultimately drive more investors to be risk on. And we've seen that in our hotel investor survey, which we released, which to your point, over 80% of investors indicated that they expect to be net buyers of hotels in 2024, which is the highest that we've ever had in our survey in over 20 years of conducting the survey.
And a lot of that, is that really, Kevin, it's a rate story? They just think rates stay the same or they head lower next year?
Yeah, I think part of it is a rate story. I think part of it may be a story of distress and the expectations that there could be some distress in the marketplace, in which case I think investors are looking to take advantage of that. If you look back during the COVID period, there was an expectation that there'd be a significant amount of distress, which never came to fruition. but a lot of capital was raised to take advantage of that. You fast forward 3 years, we're in the midst of an aggressive Fed tightening cycle, and I think the same mentality holds, which investors expect because rates are higher, the value of many assets will go down, and therefore you could have forced sellers and there could be distress. And so I think that's part of the thread. It's perhaps a more benign rate environment, but also the possibility of distress.
What does all of this imply about demand for lodging, right? We've been looking at some analysts who cover the industry who seem to be pretty optimistic about that side of the equation. But it's interesting because at the same time, we're seeing some cracks in the economy perhaps and concerns about spending. So how square that for me?
It's really interesting. There's been this dichotomy over the past 14 or 16 months where you have a very challenging capital markets environment driven by higher rates and the Fed tightening cycle, but an incredibly strong fundamental operating performance environment in hospitality. People post-COVID wanted to travel. And they took to the road and they took to the skies and they took vacations. And we've seen operating performance of hotels increase pretty significantly. So nationwide, we're up about 13% in RevPAR relative to where we were in 2019, which generally tends to be our benchmark. So if you look at the industry broadly, hotel resorts, which recovered first, are up. We've started to see a moderation in the recovery in the resorts. But what we're experiencing now is a strong recovery in urban markets. So cities like New York, Chicago, Boston, Washington, D.C., those urban markets which recovery lagged, you're starting to see that recovery take hold.
And as you guys look for maybe some hotel investment to pick up next year, Kevin, is there certain subsectors you'd really expect to see that activity? Is it luxury assets, for example, luxury hotels? Is that where you'd be looking for it?
Yes. So we've really seen it at the extremes. We've seen strong investment activity in luxury assets, and we've also seen strong investment activity in select service and extended stay assets.
What is select service? What is that?
So those are generally assets that don't have food and beverage. There's typically no room service. There's typically not a 3-meal restaurant. So it's usually a rooms-only product. So it's not going to be as expansive with the banquets and catering, et cetera, that you would see in what we call a quote-unquote full-service hotel. And then extended stay, that product will frequently have a kitchen, and it's much more conducive for
business travelers.
Business travelers, long-term stay. And look, the interesting dynamic that we're seeing is with people having greater flexibility around work, they're generally taking longer trips. And when they take longer trips, they'd like to stay in a location which feels a bit more like home. So a bit more space, and again, the optionality of having a kitchen. So we've seen really strong operating performance and investment performance in the extended stay space.
And sort of on a related note, as you see perhaps an unlocking of this investment start to happen next year, what do you expect to see sort of the biggest trend where that money is going to be flowing in terms of the features, perhaps, of either new properties or revamped properties?
Absolutely in urban markets. If you look at our survey, 84% of the investors surveyed said that they would focus on urban markets. And within urban, it will be higher quality hotels, what we call in the industry upper upscale and luxury product. Those sorts of assets, I think, will perform, one, incredibly well, and I think we're going to see a tremendous amount of liquidity and investment volume into that space.
Is there, just to sneak this in, is there any like hot new amenity that that you think hotels are going to be adding that maybe we don't know about?
Hot new amenity, that's a great question.
Sorry to stop you here.
Look, one of the interesting promises, I think, is the greater integration of AI and the predictive ability of AI to be able to deliver a more personalized guest service. And that's something that owners and the brands are working on. So in the future, I think when you check into a hotel, you may actually get an experience that caters to your likes based on past stays. And I think that's something that's going to ultimately make the travel experience much more fulfilling for our guests.
Well, that's interesting.
All right, Kevin Davis, JL, thank you for joining us today.
Thank you.
Kevin.
I appreciate
it so much.
Enjoyed it. Thanks.
And coming up, a real-life succession drama is playing out in the halls of family-owned business Estee Lauder. Stock is losing around $45 billion in market share this year. Is the business due for a shakeup? We're going to find out. It's coming up next.
A real-life succession drama is playing out in the halls of one of America's most recognizable beauty dynasties, Estee Lauder. Since the company was founded more than 70 years ago, the beauty brand has been in the hands of the Lauder family. Now, as the stock has been plunging, losing around $45 billion in market cap this year, the board and the family may be due for a shakeup. Emily Glazer is a Wall Street Journal writer. She's been researching what could be next for the company. And there seems to be a split in the family over the leadership of the company and the direction of it. Emily, what can you tell us?
Well, like many families, there's a father-son dynamic and a little bickering going on here. The difference is that this is a huge public company, part of the Fortune 500. And our reporting shows, based on sources, that the patriarch, Leonard Lauder, who is actually the son of the namesake founder, Estee Lauder, is dissatisfied with the current CEO, Fabrizio Freda's leadership these days. The stock has plunged 50%. The family's wealth of their stakes have gone down $15 billion this year. And then you've got his son, William Lauder, who has also been a CEO of the company. He's currently executive chair. He brought in Fabrizio Freda under him years ago, and he supports Freda, wants to see him turn around the company's strategy and see that through. And each of them have different board members that are on their side. So there's a lot of drama going on in that boardroom right now.
And Emily, you touch on this in the piece. Let's say there is a shakeup in the C-suite, and the CEO is gone. Who do we think is next in line? Who are some possible contenders here?
Well, that's always the big question, right? We have got an internal shortlist that includes yet another family member. On the other side of this family tree is someone named Jane Lauder. She is the younger daughter of Ronald Lauder, who is the brother of Leonard, and Ronald is the younger son of Estee Lauder. So I'm giving you a lot of names right here. This is a complex family tree. Jane is on the internal shortlist. There's also someone named Stéphane de la Faverie, who is an executive who was just promoted about a year ago. He runs about half of the brands at the company. And there are others on the short list as well. And these are really a lot of internal contenders, but my sources say, and our reporting shows, that some board members are considering, do we need to bring in an external candidate? Do we need to shake up this company potentially so much that someone has to come in from the outside? And those are some questions that are informally happening among some board members right now. And that's often what happens before bigger changes are made.
And Emily, when you were talking to your sources for this piece, when they think about the next CEO, is there a specific kind of skill set they think that CEO needs to bring to the table at this time when this business is under real pressure here? Stock's down 50% this year, Emily.
Would it surprise you that they don't agree on what kind of skill set? There are folks that believe a turnaround expert needs to come in, someone from the outside. There are literally folks who focus on companies going through restructurings. They come in, they turn it around, and then they go on to the next. Others believe they need someone who is a brand expert. Estee Lauder has dozens of different brands over the years. We're talking, Clinique, MAC, Bobbi Brown, Aveda, Jo Malone, the perfume company. These are companies they've both built from the ground up and also brands that they acquired. And then there are folks that think they need a CEO who will just boost morale. No matter what, morale's been low. The company, the stock has plunged. Their business in China is struggling so much. And there's a sense that, they might need someone to do that. And, you could have an external or internal candidate. And the other people are saying, wait a minute, Fabrizio has this amazing turnaround plan. Let's have him see this through. There are some big targets coming up end of March, end of June. So hold your horses.
Emily, we are fascinated collectively, I think, safe to say, by these types of succession stories. You're lucky enough to be able to cover this stuff all the time. Is it more common than not to have, especially at this point in the life cycle of the company, this kind of conflict? Like, in your reporting, do you see this more often than you see sort of peace and love and lack of strife?
I write about a lot of CEO successions. I cover business leaders and governance for the Journal. I have never seen anything like this. It's because it's a public company, large public company, but the family still has a controlling stake worth about 35%. Leonard Lauder alone has about a 20% stake in the company, and different family members also have, pretty high percentages. So they have a controlling stake. They have multiple seats on the board of directors. There's 15 board members, and there's an agreement that Leonard and his brother Ronald each get 2 seats. So, these different sides of the family. There is always tension in family businesses. I think it'd be hard to find someone who says there isn't, but to have such a large public company and have such a big controlling stake of the family, it's rare. But, look, there are companies like LVMH where there's a succession kind of battle brewing among the 5 children of the Titan Bernard Arnault, who's one of the richest people in the world. It happens, but a lot of these families like to keep the tension private. And we know from our reporting that the Lauder family has been desperate for this to not emerge into the public sphere.
Emily, it's a great piece. I encourage everybody to read it. Exhaustively reported. Congrats on it, and thank you for joining us.
Thank you.
And coming up, Apple plan to make it easier to send text messages between an iPhone and an Android. Find out how they'll make it happen. It's coming up next.
Welcome to Yahoo Finance's group chat. I'm Josh Schaefer here with Alexandra Canal and Praz Subramanian. And today we've been talking a lot about, or one thing that we're talking about a lot today is Amazon once again putting the pressure on employees to come back into the office. Now, this is a report from CNBC, and CNBC citing Amazon's internal website. And what they said that Amazon said on their internal website was that employees have to come back 3 days a week if that is part of their job expectation. If the expectation is them to be in at least 3 days a week, they need to be coming in for those 3 days if they want to get promoted. So saying you need to match the RTO policy essentially if you want to get promoted. Pras, I know you love RTO and you love being in the office. How you feeling about it?
Well, so digging a bit deeper, and I guess there's an internal job post talking about if these performance metrics, i.e. being in the office, matter. If they do, then it's part of your job. Then it will be part of the promotion process. And if actually you want a waiver, a VP level person can actually sign off on it. And you don't have to adhere to it. But it kind of goes back to the whole thing where we're talking about these tech companies that you don't necessarily need to be in the office to do the work. Why are the Amazons of the world and other tech companies saying, no, come back, we want you to come back? I just don't get it. But Andy Jazz, he talked about how he wants to see you in the eye, he wants to see that team bonding, and I guess it's important to me as the CEO. So there you go. That's why.
Yeah, and Amazon has had this stance for a while. I mean, Andy Jassy came out in February and said this is something he expected, that employees will be in at least 3 days a week. 3 days a week, not terrible. We've seen this phenomenon across the board.
It's a crazy concept having to go to work.
Well, really.
It's a crazy concept in 2023.
Well, really, all industries, I feel like.
Just like go do your job that people pay for.
Well, the hybrid work environment, I think, has exploded. And the argument being, look, there are a lot of 100% remote jobs out there. If you really want to be remote, leave Amazon. But no one's going to want to do that because it is Amazon. If you want to work at this tech giant that is well-known, well-respected, that's their policy. You have to go into the office.
Just real quick, I'll say the only issue with that is you might lose a lot of big talent from like a technology coding engineer point of view. They're gonna be like, you know what, I can get money anywhere, I can work anywhere I want. Why do I gotta do this for Amazon? That's the only flip side is you might lose some talent.
I just at least appreciate that they're being straightforward, right? If it says come in 3 times a week, come in 3 times a week if you want to get promoted. Otherwise, you're going to have a hard discussion with the manager, and at least it's quantifiable. I appreciate that in the hybrid
instead
workplace
of not
concept.
saying that and then you going through your
straight
job
out and saying what they want, and there's a clear deliverable there. I appreciate that.
And they're allowing for flexibility if you need a case-by-case basis from someone like Elon Musk, who has other issues right now. It says there's no case-by-case basis. If you want to actually work from home, you got to email me directly, and I'll approve it.
Yeah,
so,
who's doing that? No.
Exactly.
Yeah, well, one person that will be returning to a brand new place of work will be Michelle Mendelovitz, who has just been poached from Sony to head up Mattel's new TV studio. And this comes as Mattel has been really shifting its strategy to focus more heavily on entertainment. The TV studio has premiered 12 animated and live-action series and specials so far this year. On the film side, we are going to be seeing even more movies from the Barbie success. We have a Hot Wheels movie coming out, Polly Pocket, Barney. So really focusing on their IP, their top-rated, recognizable intellectual property and leveraging that in order to drive more brand awareness. So I think it's a really smart strategy for Mattel. It really makes the toys cool again. Because, Barbie's been around for a while, and now all of a sudden people are talking about it the most that they've ever talked about it this past summer. It's a reason to kind of keep the brand and the company in the conversation.
I wonder, there's not another Barbie though, right? In the same way that there's not another Taylor Swift, and we talked a lot about the girl power
there are multiple
summer,
Barbies.
But no, my point is Hot Wheels isn't Barbie, right? The other, Barney can't be Barbie either. And at what point, how far down the chain can you go with less popular toys and have it work versus it becomes something that doesn't work? I think there'll be other things that do work. I just don't think you're going to see Barbie again. Barbie's huge.
Right.
Barbie's a massive toy.
Well, there's American Girl doll. American Girl doll's huge.
I'm interested to see what they do with Hot Wheels as a Hot Wheels. How do you take that from toy cars to where Barbie went to become a cultural phenomenon? I think you're right, Josh, about the fact that Barbie is so huge. It's like America's apple pie baseball, maybe Barbie. I don't know. So
Barbie went through a bit of a period where people were not really embracing Barbie anymore. They said it had unrealistic beauty standards. So it definitely went through a period. This was a revamp recently.
Yeah. And I will say that if you can do it right, it's a slam dunk. It's free money almost. Kind of reminds me of the reverse where George Lucas made billions, literal billions from Star Wars by retaining the product, the licensing rights. So if you're Mattel, you should do it. It's smart to do that. But I'm curious if they can leverage it.
Right. Well, if you look at their third quarter earnings, they did report a 9% rise in net sales, and that was driven by a surge in invoices for dolls, which jumped 27%, and toy vehicles jumping 18%, and really that was driven by Hot Wheels. So we'll see if that trend can continue.
Okay. Well, moving on to Apple. The old iMessage, this is a kind of a big deal, making a big U-turn here on text messaging and making it easier for iPhone and those Android users to chat more seamlessly. You can allow for stuff like read receipts, images, video to go in more seamlessly. You're not going to have sort of the issues where people get kicked out of group chats and things like that. But what's not changing is the fact that if you're iPhone, you're blue bubble. If you're not, you're green. What do you guys think about that?
I think the top piece that's on the graphic right now, text Android users over Wi-Fi, is the biggest takeaway for me here. That's what people love about iMessage, right? You don't need to actually have cell service. You can go to, say, Europe, and you can communicate with someone here by just being on Wi-Fi, and you don't need to pay for the expensive plan or whatever. So to have that is advantageous for both sides, and I could see why Apple would want to do that.
Yeah, and it's a totally different messaging system, RCS versus SMS or MMS, so it makes those things much easier to do. And I know I've been frustrated before texting a non-iPhone user. I don't know if it's sent. If it, at least when the blue says deliver, the text has sent.
Yeah. I got a question for both of you guys. As young single people, if you got matched with somebody, whether online or not, and you texted them and you got a green bubble back, would you be
at first
less
I'd be
inclined,
like,
or say, I don't know about this?
at first I'd question if the text didn't go through. I'd be like, oh no, did the text not go through?
You're like, oh, they
And
gave
then
me a
maybe
fake
I would
number.
risk-
They gave me a fake number.
Maybe
they
I'd
gave me a
risk
landline.
double
That would be
texting
my first thought.
a
Someone
landline?
gave me a landline number. If that's green, you're like, oh, that's not a cell phone. You want it to be blue when you type it in, right?
Yeah.
There is a
Every time I
certain
type in a number,
status
you
with
want
the
it to be blue.
It makes you
versus
feel
the green.
safe.
Makes you feel safe.
Said that too.
Yeah, I don't know though if I would flat out reject someone solely because they have
has
a
been a
green
thing.
bubble, which I know has been a thing, which is crazy, but we'll see.
Looks like that won't be resolved for now, right?
Yeah, for now, we'll keep this debate to ourselves. But switching gears here, yesterday we inaccurately categorized a change to Robinhood's Gold product. As of yesterday, Robinhood Gold customers can now earn a 5% annual percentage yield on their uninvested cash in their account. This money will not be in a separate savings account. So, this is something that Robinhood recently rolled out. Their stock has been a bit under pressure. They're looking to bring more consumers to the platform. With interest rates top of mind right now, this is what every consumer is thinking about. This could be something that maybe they leverage.
Oh yeah, it's an advantageous move for customers of Robinhood, right? To be able to get 5%. You want to be able to get 5% on uninvested cash, right? That's something that you can get through different means in different ways. Now you don't have to go try and get a Treasury Direct account process and buy a bond. You can just have some uninvested cash, get 5%. Seems like a good play for customers of Robinhood to be able to just take advantage of that.
It's funny that you have to be part of this subscription product as opposed to just getting the money in your uninvested cash. I do got to say though, Vlad was saying that banks are kind of ripping people off with their low accounts, yielding accounts.
Well, the average is around 0.6%.
So he wants to sort of give you a little bit back more. Get some of those younger investors, those younger people who are trying to get into finance, get them on the Robinhood platform, and maybe this is the way to do that.
Yeah, I mean, it was a fair reminder, I thought, to just generally, if you were to use an overall savings account at a bank, like a big bank, one of the big banks, and you just have a savings account, you don't pay attention to what you get on that, those accounts don't yield much.
Right.
He was not wrong in saying that at all, and that is something that I think a lot of people don't notice, right? You just sort of park your cash there, you're happy with that checking account that you had for 20 years, and people don't actually look at other options, like, say, putting your money in something different.
Yeah, consumers don't think about it. And sometimes consumers don't even know that there are other options out there. But something that we do know is that it is Friday. And coming up, we are keeping you posted on what to watch next week. We will break down the stories you need heading into the weekend. See you on the other side.
I think it's
We are taking a look at shares of Microsoft as Sam Altman departs as CEO of OpenAI. The company announcing a leadership transition. The board saying Altman had not been, quote, consistently candid with his communications with the board. So investors are watching now AI players like Microsoft, of course, which has a multi-billion-dollar partnership with OpenAI, to see what the implications of all of this are. As we were talking about this earlier, this raises more questions than it answers, but people are looking at Microsoft, people are looking at Alphabet, because of course there is competition here over the AI landscape, how it's going to be affected by a switch in leadership at this very important player.
Yeah, as you pointed out, I mean, there's a lot more questions here at this point. What does not being candid mean exactly? Was Altman not candid about the business? Was it a personal issue? We're not sure about this. But Sam Altman, we should mention, has tweeted now. Let's get to that. I love my time at OpenAI. He posted it was transformative for me personally, and hopefully the world a little bit. Most of all, I love working with such talented people. We'll have more to say about what's next later. And listen, as you suggested there, Julie, I mean, under his watch, not only did OpenAI surge in popularity, I think it's facing, Altman's profile surge in popularity. It was Altman. Remember over the summer, he was kind of doing this world tour from India to China, meeting leaders and government officials. He truly did become the face, not just the company, but of the industry.
Yeah, most definitely. There's a lot of speculation out there now about what exactly happened here. And of course, as always, when this kind of thing happens, you want to take a step back, take a breath, try to look at everything with a very skeptical and critical eye here as we try to figure out what exactly happened here and what will happen next for Altman himself. As he says, there's news to come on that front, and also for OpenAI as an organization, and more broadly for the industry here. What is Microsoft going to do as this happens? Are they going to position to get more control of OpenAI? We'll have to see. We're going to be doing a lot of
Microsoft did offer the following comment to Axios, by the way, saying we have a long-term partnership with OpenAI, and Microsoft remains committed, they said, to their team as we bring this next era of AI to our customers. So listen, more to watch, as you said. Lots of questions.
Yeah.
All right, now time for what to watch next week. Let's get to that. It's the holiday shortened week for Thanksgiving, of course. On Tuesday, we're going to be getting minutes from the Fed's last FOMC meeting, the minutes to provide a better look into the Fed's decision to hold rates steady. Meanwhile, on the earnings front, the last of the Magnificent Seven, Nvidia, to report its third quarter results. Chip giant to report its earnings after the market closed on Tuesday. Other names expected to report next week include HP, Baidu, and retailers Lowe's, American Eagle, Dick's Sporting Goods, and Abercrombie & Fitch. And turning to the sky, SpaceX set to make the second launch of its massive Starship spacecraft Saturday morning. This comes after the April explosion, remember, of the Starship system's first test flight. Then lastly, Formula One comes back to Vegas this weekend for the first time in decades. F1 CEO telling Yahoo Finance earlier this week they've invested $600 million on its latest bet on the U.S. That race that will speed through in Sin City Strip begins at 1 a.m. Eastern Time on Sunday.
That'll do it for today's Yahoo Finance Live. Be sure to come back on Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. I hope everyone has a fantastic weekend. I think Josh and I are going to be on our phones quite a lot. Have a good one, everybody.